near the $76 per barrel barrier. The Fed's interest rate decision yesterday was apprehended as dovish by the market and caused the dollar's fall to fresh 9-month lows, and energy traders' focus turns towards the looming European Commission's proposal for a price cap on Russian crude. In this report, we aim to shed light on the catalysts driving WTI's price and assess its future outlook. After a grim global outlook forecast at the start of 2023, the International Monetary Fund revised its predictions and pointed out that China will be the key driving force behind global growth for the year ahead. Even though inflationary pressures, high interest rates, and the ongoing war in Ukraine persist, the fund upwardly revised its forecast to 2.9%, up from the initial 2.7%, citing that economic growth proved surprisingly resilient in the third quarter of last year, with strong labor markets, robust household consumption and business investment, and better than expected adaptation to the energy crisis in Europe. Inflation, too, showed improvement, with overall measures now decreasing in most countries, even if core inflation, which excludes more volatile energy and food prices, has yet to peak in many countries. The organization's chief economist, Gurinchas, placed significant importance on the prospects for better than expected recovery of the Chinese economy after the abrupt pivotal abandonment of its strict zero-COVID policy, and stated that the reopening paves the way for a rapid rebound in activity. He added the restrictions and COVID-19 outbreaks in China dampened activity last year. With the economy now reopened, we see growth rebounding to 5.2% this year as activity and mobility recover. Besides China, the IMF foresees India playing a big role as well, stating that together with China, India will account for half of global growth this year, versus just a tenth for the US and Euro area combined. Despite the optimistic outlook projections, however, the organization reminded that the global economy is poised to slow this year before rebounding next year, and growth will remain weak by historical standards. Yesterday, the OPEC Plus ministerial meeting failed to provide oil traders with significant information, as the committee reaffirmed that the oil cartel will keep its production quotas unchanged for the foreseeable future. In November of 2022, OPEC Plus decided to cut its production output by 2 million barrels per day until the end of 2023 to bring the market back to equilibrium. The head of OPEC Plus, Al-Ghais, at the time stated that the reason behind the decision was the apparent deviation between market fundamentals and oil prices, vowing to protect the cartel's interest. According to Reuters, the ministers did not discuss about the prospects of increased demand from China once its economy returns to normal, neither about supply-related concerns from Russia, whose exports will soon be subject to a European ban and G7 price cap. China's pivotal shift near the end of 2022 to abandon its draconian COVID-related restrictions and opt for a full-fledged reopening have boosted optimism for higher oil demand in recent months and prompted speculations that OPEC may be incentivized to increase output to match the thirst of the second largest oil-consuming country. On Tuesday, the weekly AP crude oil inventories figure pointed to a buildup of 6.3 million barrels in stocks, higher than the expectation for a drawdown of around minus 1 million barrels, while yesterday EIA's weekly oil inventories recorded a rise of 4.1 million barrels of crude, exceeding expectations of 0.37 million for the same period. The results suggested a weakening demand for crude, which may have contributed to the fall of WTI prices in the past few days. It's important to strike out that the AP crude oil inventories have been piling up for 5 consecutive weeks, while the EIA's inventories recorded a 6-week string of buildups, the highest in over 2 years. Lastly, we would note that last Friday, the Baker Hughes oil rig count showed that the number of active oil rigs in the US has dropped by a count of 4, reaching a total of 609, which could serve as another indication for a slowdown in demand.